You ever open up a professional stock report and just your eyes glaze over? It's this wall of text, right? Jargon, numbers. It feels impossible. Well, today, we're going to crack that code. We're going to find the story that's hiding in plain sight. Yeah, it's that feeling of being hit by a wall of jargon, charts, and ratings. But what if I told you there's a clear narrative inside, if you just know where to look? Come on, let's find out. And our guide for today will be a real-world example, a report on new holdings. They are a huge deal in digital banking, especially down in Brazil. And honestly, their story is the perfect puzzle for us to solve together. So here's our game plan. First, we'll break down the report itself. Then we're going to dig into Nook's specific valuation puzzle. After that, I'll explain this really important concept called the economic moat. We'll see how it all adds up to a final rating, and we'll wrap it all up with the big takeaway for you. All right, first things first, let's decode this thing. The real trick? Stop trying to read it like a book. Think of it more like a puzzle you have to solve. And the very first clue is figuring out what analysts think the company is actually worth. And that leads us to a super important term you gotta know, the fair value estimate. Think of it as the North Star of any stock report. Now, this isn't the price you see on the stock ticker. No, this is what the analysts, after all their number crunching, believe a single share should be worth based on its future. So the whole game is basically comparing this fair value to the actual market price. And for new holdings, just look at this. The numbers are incredibly close. The market price, $16.62. The fair value estimate, $16.56. I mean, that's practically a perfect match. That gives it a price to fair value ratio of exactly 1. Which is why you see that fairly valued rating right there at the bottom. But, and this is a big but, don't let that simple label fool you. The story here goes way deeper. Okay, so now we get to the really interesting part, news valuation puzzle. This is where we find the real tug-of-war in their story. It's this classic fight between insane growth on one side and shareholder returns on the other. So on one side of the scale, you've got this incredible world-class growth, but on the other side, zilch. Zero dividends, which, are those direct cash payments to people who own the stock. And these two things, pulling in opposite directions, are what make valuing a company like News so fascinating. Let's put a number to that growth, shall we? 55.2%. That is News' average revenue growth over the last 3 years. To put that in perspective, that puts them in the top 10% of companies globally. That is a massive, flashing sign that they are just gobbling up market share. But then you flip the coin over, and you see a big fat 0. That's their dividend yield. See, this company is plowing every single dollar it makes right back into growing the business. Nothing is being returned directly to shareholders as cash. And if you're an investor looking for income, well, that's a huge red flag. And look, this isn't just some casual observation. It has a real direct impact on the company's valuation. The report says it right there in black and white. This unfavorable dividend structure weakens our estimated valuation. So why is that? Well, dividends are seen as this stable, predictable form of return. When they're not there, it just bumps up the perceived risk. All right, so what do we have? A super fast-growing company that doesn't pay out dividends. Got it. So the next logical question is, can they keep this up? How durable is this business in the long run? And to answer that, we have to talk about something called the economic moat. Don't let the fancy terms scare you. An economic moat is just analyst speak for a company's competitive advantage. The thing that keeps rivals at bay. It's that special sauce that lets it generate big profits year after year. And this image here, it's the perfect way to think about it. Just like a real moat protects a castle from invaders, an economic moat protects a company's profits from its competitors. Simple, right? The wider the moat, the safer the castle, and the safer the business. So the big question is, how wide is Nu's moat? Well, according to this report, it gets a narrow rating. Now, narrow is pretty respectable. It's not none, which would mean it has 0 defenses, but it's also not that holy grail wide rating you see with companies that are practically untouchable. So what does narrow actually mean for an investor? Well, it suggests that the company's competitive edge is strong enough that it can probably keep earning profits above its cost of capital for at least the next decade, maybe more. It's a good sign of a solid business, but maybe not an invincible one. All right, it is time to bring all these pieces together. We've looked at the valuation, that push and pull between growth and dividends, and we've sized up its competitive moat. So let's see how all these clues come together to give us that final, all-important star rating. Analysts don't just pull these ratings out of thin air. There's a process. First, they analyze the valuation, price versus what it's worth. Second, they assess that economic moat, its competitive edge. But then there's this third, crucial step. They have to factor in uncertainty, which is really just them saying, how confident are we in our own numbers? And for a rocket ship growth company like Nu, that uncertainty level is high. So you take all three of those things, mix them together, and that's how you get the final star rating. And the final verdict for Nu Holdings is, drumroll please, 3 stars. A 3-star rating basically means the stock is considered fairly valued. It's not a screaming buy, that's what 4 or 5 stars are for, and it's not an urgent sell, that's 1 or 2 stars. It's neutral. It's sitting right in the middle, especially when you remember that high uncertainty tag. And the report's own summary really hits this home. It calls Nuo a balanced choice, but then says that prudent investors should consider looking elsewhere. It's not a no, but it's definitely not a yes. It's a firm maybe. Okay, so we've pulled apart the report on Nu Holdings. Awesome. But what's the point if it doesn't help you? So let's take everything we've learned and turn it into a practical toolkit you can use for literally any company. So next time you open one of these reports, here's your checklist. First, look for the story. What's the main plot? Is it all about explosive growth, or is it about steady returns for shareholders? Second, figure out the moat. How strong are its defenses for the long haul? Third, and this is a big one, always check that uncertainty rating. If it's high, that's a warning sign. And finally, please remember, a 3-star fair value rating is not a buy signal. It's a yellow light. It's a call for caution. And that brings us to one last really big question, one that gets right to the heart of this whole puzzle with Nu Holdings. For a company that's all about growth, what's more valuable? Building a really strong, durable, competitive moat for the future, or giving shareholders some cash back right now with dividends? There's no single right answer to that. It really comes down to what kind of investor you are. But now, you're way better equipped to figure out your own answer. That's all for today. Thanks for tuning in.